Good morning, ARMR Insiders. Welcome to the morning call. Welcome to everybody who may end up listening to this on YouTube later today when I release it, because tomorrow I'll be off the desk. There won't be a Saturday call. We have cousins in town doing all kinds of things. So thought I'd just share some thoughts on the week right now and what we're doing today and how we're carrying our portfolio into the weekend. So as always, this is the ARMR Report. It's about investing in the stock market. It's following the ARMR investing way. 3-stage process. We build our whiteboard. Question, how do we build that whiteboard? And ARMR Insider's asking about you, Maxim. And I'm telling you right now, the cornerstone of building a whiteboard is the William O'Neill style of investing. And you can read the book, How to Make Money in Stocks, to give you that foundation. Okay, How to Make Money in Stocks by William O'Neill. It's on Amazon. Full disclosure, I don't get paid for that. I'm just sharing with you information about that book. I first read that book over 35 years ago. Okay, and it's literally been, the very basis of how I do research. Okay, so anyway, stage 1. Know how to build a whiteboard. Stage 2, use algorithms. We're going to share that with you. The algorithms we use, both big index, big picture algorithms, all the way down to single stock algorithms and day trading algorithms. And then we, of course, wrap it up with a bow of stop losses to protect ourselves from ourselves. So the ARMR Report, if you get nothing else from this, it's about protecting capital first, capturing upside second when the window opens, and your net worth follows over time. You don't have to stare at the P&L. You have to execute the strategy, and you'll get to the result you want. And it's not about chasing the hottest idea of the moment, trying to see which stock might be up 100% this afternoon. That's not how you manage a large pool of capital, okay? So you protect capital first, capture upside second. And that's what we're doing on the desk right now. We've been doing it for the last couple of months as we've geared our portfolio towards a dividend portfolio, a low beta portfolio, a portfolio that chooses cash as an allocation right now. There's a common misconception that you've got to put all your money to work all the time. It's just not true. It's not true. There are great times to have cash as an allocation and be patient and opportunistic. When the market comes in, put that cash to work, and then all of a sudden you're building alpha. So we've got about a 45% cash position in the portfolio right now. I'm going to use that cash to day trade indexes, particularly the S&P and the NASDAQ from the long side. What I like to do is what I call alpha extraction. Okay, I want to extract alpha from the market. So whenever the market gaps down or sells off more than 0.5% in the morning, the S&P, the NASDAQ, and we can find our way into the market for the rally back in the afternoon, we just captured some alpha. And I'm not going to hold it overnight. I just book my profit, use the cash the next day, keep looking for those opportunities. We have a high probability of success doing that on the ARMR trading desk, the ARMR Pro live trading desk, where I share with you the algorithms we use to make those choices. We don't trade every day, but there are specific setups we use with a high probability of success where reward's worth the risk. And when we see that and we have a large cash allocation in the portfolio, we use that cash to capture the alpha, okay? Ultimately, there may be a time where we put that cash to work correctly. Market's down 0.5%, 1%, put the cash to work. Market closes the day up 1%, and we have this position on that we're, with fairly large profits. We might carry that overnight. It might become a swing position. Okay, so opportunistically putting cash to work is where we are at the moment with part of our portfolio. The other part is a dividend-producing portfolio. I know it, and I know that's strange if you watch CNBC or all these different financial networks. They're all telling you the Fed's going to be raising rates. There's going to be, tapering, or not raising rates, but tapering, or maybe at Jackson Hole, or the news wires love to talk about non-voting governors that are Fed governors, that are non-voting, and they're all out there jawboning, oh, it's time to taper, okay? I'm going to show you 3 charts, and then you tell me if you think the Fed's in the process of tapering. All right, this is the captain's log. I write it every morning for ARMR Insiders, okay? So the first is this chart right here. I wonder if you guys can see that. This is the Fed balance sheet, okay? See if we can blow it up. There it is. Okay, this is the Fed balance sheet. Okay. Does it look like there's any type of taper going on? All right. Just absolutely massive acceleration of the Fed's balance sheet. So it's hard to believe. You could talk taper all you want, but we have to keep our eye on this simple chart. If the Fed's balance sheet keeps going like this, any type of, quote, taper tantrum is going to be short-lived. Then we roll down here and we look at the Treasury chart. This is 20-year Treasuries. And now what I'm going to do is I'm going to, whoops. I'm going to go here. All right. We're going to look at Treasuries now. So this is TLT, the ETF of long-dated Treasuries. And it's good to look at this every now and then to get a feeling for where interest rates are going, right? When this asset is going higher, interest rates are going lower. When this asset goes higher and interest rates go lower on government securities, dividend-paying stocks go up because people are searching for yield. And so they move down the chain trying to find yield, okay? So what we have right here, this breakout right here was based on a pandemic scare. So then we had the collapse back down to the pre-pandemic level. See that? And we had a big discussion on the trading desk, the ARMR Report, and on a couple of our Saturday morning discussions of concerns. When this was happening, there was discussion, oh no, this is real bad. And I tried to explain to everybody, there's nothing wrong with the sell-off here, right? If you guys remember this conversation, I said, this has nothing to do with rates. This has to do with a pandemic that's no longer a pandemic. So rates have gone back to where they were before the pandemic. See that double green line there? You're just in a range of where rates were going, where they were trading before the pandemic, right? Now, rates are headed south. Price of treasuries are in an uptrend. Explain that to me. All I hear, all you all want to tell me, not you all, but what I hear all the time on Twitter or whatever, Russia, China, everyone's dumping treasuries and, Fed's going to taper and blah, blah, blah. Go look at this chart, okay? If any of that were true, you would not have an uptrend in treasuries. Okay, as long as this is happening, let me show you what benefits the most when this is happening. Ready? That is happening. This is the ETF of utilities. We took a position right in here in this green box at the ARMR Report. Before it broke out of the pennant, before it broke out of the cup and handle, we were buying utilities, right? Massive pennant formation breaking out as TLT goes higher. So there's 3 basic charts for us to watch. The Fed's balance sheet, treasuries, long-dated treasuries, right? Because they're most affected by interest rates, and utilities. They're telling us a story. So could there be shocks? Could Jackson Hole be horrific and they make some announcement of tapering or whatever and things could, jerk around? It's possible. But when we look back at the end of a month, not just a day or two of volatility based on headline whatever that algos trade and things go berserk. I'm saying you look at the end of the month and you keep seeing the Fed's balance sheet go like this, and you see treasuries going like this, you see rates plummeting and utilities going up, chances are we're not going to really be in a bear market. So let's get to what do we do with the cash? Why do we have so much cash? Well, take a look at the indexes, right? They're really masking some destruction that's going on underneath the market. If you look at the S&P, there's just absolutely nothing wrong with that chart pattern yet. Okay, so we're in a cash position that's really as max cash as I'm going to be right now. I don't need any more cash than I've got. I'm going to hold the rest of the portfolio and collect that dividend unless we get a risk monitor red signal that leads to a risk off margin call type of market, which is what we had last year during the pandemic. Everything goes down in that environment. It won't matter if it pays a dividend. Everything will get crushed. Now, if you're a long-term investor, and I run different portfolios, I have my own capital allocated in different types of portfolios. I have a dividend portfolio, and I almost never touch the positions. I just collect yield. I put positions on weakness. Something gets wrecked and the yield pops and I want to own it. I put it on with a very lenient stop and I leave it alone. And I just let it go and collect my yield. Okay? There are times when you get this risk off margin call implosion that for the rest of my portfolios and the ARMR spreadsheet and the ledgers that I share with you guys, I'll lift stocks out because that's I'm very concerned with preservation of capital, right? So for the majority of my assets, if we get that risk off signal and we get a margin call type of market, it doesn't make a difference if it pays a dividend, I'll sell it. But for now, if you look at this market, there's nothing wrong with the market, right? The S&P only had 2 down days. If you looked inside the market, you'd think that there's like some type of implosion going on, right? Look at Caterpillar, just totally a breakout that imploded, right? I don't know what Deere is going to do today, but Deere was what looked like an unbelievable breakout and imploded. Of course, they had earnings announcements, so it's up 1.5% right now. So maybe it stabilizes. Okay, you're just getting some breakdowns across the board in all kinds of old economy. Look at General Motors. I mean, these things are getting destroyed. How about a dividend payer of CVX? Chevron's imploding. Okay, so we already know that the innovator stocks got wrecked earlier this year and they've yet to recover. Now we're getting economy reopening type of industrial stocks that are getting destroyed. And yet you look at the S&P and it grinds higher. And you look at the NASDAQ 100 and it grinds higher. And look at the Dow Industrials and it grinds higher, right? And look at the Dow. You wouldn't necessarily know that there's destruction going on underneath the Dow because that's happening. All it did was pull right back to the 50-day moving average. So what would get us to get more aggressive in a cash stance, raise more cash, is to have the risk monitor go red. And it's not going to do that unless we see the Dow, the NASDAQ, and the S&P break below the 50-day moving average and close below it on a weekly basis. And that will probably trip the ARMR algos to get risk monitor red everywhere. All right. I'm not going to preempt that. I've preempted as much as I can by carrying a lot of cash and going low beta. The reason we did that is because we're looking at the small cap index as our guide, right? It's the canary in the coal mine. And that is without a doubt breaking down from a double top. Okay. And now below the 50 and challenging the 200, right? And God help us if it breaks below the 200 day. Okay. But until that happens, I'm not preempting anymore. Until that happens, until we see that big indexes follow the small caps, we're going to be in this position of cash, dividend payers, low beta, using cash to day trade. Volatility is going up, which means day trading gets a lot more effective. The swings are bigger, so you get paid. The reward is big enough for whatever risk you're taking, right? So we focus on that in times like this. I'm not carrying a put position on small caps or short position on the small caps overnight right now. I was doing that for a couple of days. We made some really good money on those puts on the small caps. And the reason I've taken them off now is that I really only carry those types of positions overnight to hedge a portfolio that's, aggressively long. Now that I've got a bunch of cash, I don't need that hedge. And I would much rather day trade. This is a word to the wise. I'm just going to share something with you I've learned over the years. I hope this helps you. In a correction/bear market, okay, the amount of money we can make day trading is so large. I don't need the risk of a short overnight. the crazy thing that happens in a downtrend is you get vicious volatility. So if you overstep and have too big of a short position / put position on overnight, what happens is there'll be a day in the downtrend, many days in the downtrend, where the market gaps up 1%, gaps up 2%. Okay. And the pain you will suffer in your put position will just be like almost too much to bear. And then what happens is you completely go on tilt. You end up taking your loss on the puts because you're like, oh my God, I'm getting crushed on these puts. Then it implodes into the close and you don't have your puts on, right? And it just sends you right, into the insane asylum. So when volatility spikes, I find it's best to day trade short and long. And what you really get in a downward trending market is 2 and sometimes 3 trades a day. You get, if the market gaps down, you get a long trade in the morning. So the market runs in the morning, fails, you put your puts on, and it implodes to the close. So you get 2 trades and sometimes 3 when it's completely hysterical. When the market's really hysterical, it'll open up flat, implode. You could get short, and it rips higher, and then it implodes again, right? But that's usually near the end of the market implosion. The volatility just goes nuts. So wrapping up, thoughts for today. Probably not making a major shift in the portfolio going into the weekend. Going to carry that cash, going to use the cash for day trading purposes. Not going to get too negative just yet. We don't have risk monitor red. We look at those 3 graphs. Fed balance sheet keeps ballooning, treasuries going up, yields going down. That's generally not a market that's imploding. Generally. I mean, it could be, but generally not, right? So while we could take some precautions to protect our capital, you don't want to allow your imagination to get so negative, right, that you overweight that negative side and the market just keeps grinding higher. Okay, so we're in that balanced position. We collect that yield, and then I'm doing research looking for other yield plays I want to add to the portfolio. Here's one name I'll just share with you. We were talking about it yesterday on the desk. Let's just go over what's in the portfolio, right? We have AbbVie in the portfolio. We're collecting a 4.5% yield there. We got Bristol Myers in the portfolio. Take a close look at this chart pattern because you're going to see something very similar to this in a minute. Okay? Bristol Myers going up for us, right? We own shares of Gilead in the portfolio, right? Look at this chart pattern. It's nice, tight pennant formations breaking out. We own it inside the pennant before the breakout. We're not chasing anything, right? Johnson & Johnson in the portfolio, right? Okay, and of course, the centerfold of this whole portfolio is Pfizer, right? We bought it tight inside the base here at a 4% yield. So now I look at all those charts, look at all those pharmaceuticals, right? This is the ETF of pharmaceuticals. Okay. And then you have to look at Merck and say, when do we pull the trigger on Merck? Now it's only a 3.3% yield, so it's not a big yield. Okay. And they've had some difficult times, and that's why the stock is underperforming and making this perfect pennant formation. And at some point, it's going to break out of that pennant and join the crowd. And the question is, when do we add that to the portfolio? I'm considering it. I just don't know how many, pharmaceutical stocks I need in the portfolio at any one time. But boy, it's hard to argue with that pattern. So put that on the radar to consider. Also, we keep making money in Chubb, and it makes me really want to think about adding a couple more insurance companies. They're pricing in inflation. Earnings and revenue are ramping. It's not affected by, economic, swings either way. The insurance business. This insurance business is really starting to move. Travelers just now breaking out. AIG maybe is on the list. I'm thinking of broadening out my exposure Chubb's my favorite name. I mean, it's just the best name. Always has been. And it's the leader. So that's why it's the first one in the portfolio. Not seeing. I'm thinking of something else. I can't remember the symbol right now. Also, I'm wondering if I want to add shares of Dominion to my utility part of my portfolio. That chart is sick. So you may see me adding more pharmaceutical, more utility. Probably not today, but might add some more insurance companies. That's kind of where I'm leaning. And everything else, is a day trade for me. All right. Any questions? If not, I'll split. I'll see you all on the live trading desk at 9:15. We'll get ourselves set up for day trading. But I will tell you that when volatility spikes, I generally spend all of my time day trading the indexes. And it doesn't preclude me from putting a trade on. Yesterday we got long VIR for a trade. But the trades are quick. Okay, this was right in here. Put the trade on. This is the day trading chart you're looking at. Okay, put the trade on here. It ran up to here. I booked my profit there. So what I've been doing in my personal day trading account, I find that it's best for me. We all trade differently. This is how the ARMR day trading works. I put a lot of capital to work in a few ideas that are high probability entry points, okay? Where statistically speaking, using our ARMR algorithms, we know that the probability that the asset goes higher is at the optimal point and our stop loss is tight, and so I put the position on. If I get day trades on indexes, I'll get long the S&P and the NASDAQ 100. I'm going to put 50% of my capital in SSO and 50% in QLD, the whole portfolio. So I'll have 200% exposure to the market from that point. Okay, it pops up. I start booking profits at certain targets, raise my stops. Okay, had a huge day the other day in Viacom. Okay, so there's 3 different ways we day trade on the ARMR live trading desk. The first are the indexes. So on a day like today with a lot of volatility, as volatility spikes, I really focus on the indexes. Okay, and what we're doing is we're looking for, and this is our day trading algorithmic chart. Okay, so this is the S&P, just to give you an idea. Couple of trades from this week. So right in here, a double bottom, and whenever we see these yellow paint bars, that's the ARMR algo telling us it's time to get long the market. Okay, so what we look for is a pullback, sell off during the day, double bottom over a half an hour, hour-long period, ARMR trigger, use the low of the double bottom as the stop, so the stop is tight, okay? Expect a mean reversion back up to the VWAP, all right? We made a lot of money on that trade. A lot of money because we're putting a lot of money to work on each trade, right? And then, of course, right here, this was the best trade of the week. Market imploded here, set up a perfect bottom over an hour-long period, got our trigger bar, right? Market just skyrocketed the rest of the day, okay? Those are the types of trades we look for. So step 1 is to trade the indexes, look for those setups at key gamma locations, get our ARMR trigger, put all of our capital to work in that, and extract alpha. The second setup, we look for gamma squeeze opportunities and the ARMR trigger on top of them. So there might be 2 or 3 names, maybe 4 or 5 names a morning that those are really rare, 5 names. Usually it's 2 or 3 names a morning that are gamma squeeze ideas that set up correctly using the ARMR day trading trigger, and we put our trade on. When we had our Viacom trade, I'm not telling you to do this, but I'm saying personally, how do I use this information? I put 100% of my day trading portfolio in Viacom, the whole portfolio. I bought Viacom. Right? The stock popped. My whole portfolio was up 2% in an hour, and I was done for the day. Okay? So the ARMR day trading way is not to trade 10 or 20 names a day. It's to find the right entry point and trade it large and be done for the day. That's what I try to do. My own capital, I try to share with you. It's not for everybody. Your risk tolerance, you have to determine. Okay, your goals, you have to determine. I'm sharing with you a process. And if it fits and in any way can help you with your process, then I feel like hopefully I've done my job, and you find the information I'm sharing is valuable. Okay, so that's the purpose. So that's the second, setup we look for, and then the third setup we look for is again, it's always the ARMR day trading trigger that gets us long, but the third setup is a breakaway setup. I'd have to show you on the ARMR live trading desk, but what we look for are stocks that have gapped up, pull back over a couple day period, and set up at a particular location. And when that happens and we get the trigger, we put the trade on. So those are the three things we look for every day. Some days we don't find anything, right? And we just don't trade. And that's the key to day trading. You don't have to trade every day. You're not forced to trade every day. I like to say it's kind of like Texas Hold'em. You get your money in when you have the best of it, and you keep your money out when you don't. And unlike Texas Hold'em, we're not forced to put money to work. There's no ante that goes around the table. We're not forced to do anything. We could sit and wait until we get aces, and then we put our capital to work. And of course, the other major difference between what we're doing in Texas Hold'em is, guess what? We could put all of our capital in the middle with a very tiny stop loss. If it doesn't work, we get out. We don't lose all of our capital. If it does work, we get paid huge. That's the process. All right. So anyway, guys, I hope that's helpful. I won't be seeing all of you on Saturday because of prior engagements, but ARMR Insiders, I'll see you in a few minutes, certainly in the Slack room and on the live trading desk at 9:15. All right, guys, have a great trading day. And remember, protect your capital first, capture your upside second. If you make that simple change in your philosophy, I think that you'll enjoy the direction of your net worth. Okay? Have a great day, guys.